Netflix has evolved from a DVD rental service into one of the most dominant forces in global entertainment. With more than 260 million paying subscribers as of 2025, the company has transitioned into a mature, cash-generating machine while still maintaining its position as an industry innovator. Its ability to continually reinvent itself, from DVD by mail to streaming to original content to an ad-supported tier, has placed Netflix at the epicenter of media disruption. For long-term investors, the question now shifts from growth potential to sustained profitability, competitive moat, and future innovation. To understand whether Netflix is still a good investment in 2025, we need to conduct a comprehensive analysis that spans fundamentals, cash flow trends, technical indicators, and valuation metrics. Netflix's financial performance over the past 5 years shows a clear arc from aggressive reinvestment into profitability. In 2020, the company was still funding a large portion of its original content through debt and had relatively thin margins. However, by 2024 and into 2025, Netflix's operating margin has expanded to over 22%. Free cash flow, which was negative or near zero in earlier years, is now expected to exceed $6 billion in the current fiscal year. This shift is partly due to the company's decision to slow its content spending growth, optimize production pipelines, and reduce dependency on expensive external licensing. Revenue continues to grow steadily. In 2024, Netflix generated over $37 billion in annual revenue, and current projections for 2025 exceed $41 billion. While this represents single-digit percentage growth, it is healthy for a company of this scale, especially one operating in a saturated market. More importantly, average revenue per user is increasing, particularly in North America, where Netflix has introduced pricing segmentation and account sharing fees. These changes have created additional monetization levers without drastically impacting churn, which remains low by industry standards. Fundamentally, Netflix's content library is an asset that provides long-term value. Unlike many media competitors who rely on licensed content with expiration dates, Netflix owns the majority of its high-performing shows and movies outright. This allows the company to continually monetize hits like Stranger Things or The Crown over many years without recurring licensing costs. In accounting terms, content spending is amortized over the useful life of each asset, usually within 4 years, which improves visibility into future profitability. As of 2025, Netflix's total content assets on the balance sheet are just over $30 billion. But the company is now being more selective in greenlighting large projects, prioritizing ROI over volume. Netflix also benefits from scale advantages in distribution and data. The company operates in over 190 countries and uses its massive data trove to optimize recommendations, marketing spend, and even production decisions. For example, Netflix can identify viewing trends in emerging markets and commission local language originals tailored to those audiences, which then get global exposure. This feedback loop enhances subscriber retention and reduces customer acquisition costs. Additionally, Netflix's global distribution platform ensures that new content can be launched simultaneously in dozens of countries without needing third-party intermediaries. From a quantitative perspective, Netflix currently trades at a forward price-to-earnings ratio of approximately 27 times, which is above the S&P 500 average, but lower than many high-growth tech peers. Its price-to-free cash flow ratio sits around 23 times, which is attractive given the company's free cash flow growth trajectory and improving capital efficiency. Netflix has guided for low double-digit earnings per share growth over the next 3 years, driven by modest revenue growth, margin expansion, and share repurchases. The company initiated a $5 billion share buyback program in 2023 and has steadily reduced its share count since then, enhancing per-share metrics and returning value to investors. On the balance sheet side, Netflix has made significant progress in deleveraging. The company previously carried a debt load of over $16 billion, primarily used to fund aggressive content growth. As of early 2025, total long-term debt has declined to just under $12 billion, and interest coverage ratios have improved substantially. With increasing free cash flow and lower capital intensity, Netflix now comfortably meets its debt obligations while still having enough flexibility to invest in growth areas like gaming and live events. Its net debt to EBITDA ratio has declined to under 1.8, putting it in a much healthier financial position than it was just a few years ago. Technical analysis also paints an interesting picture. Netflix stock experienced a major correction in 2022 when pandemic-era growth normalized and competition intensified. However, since bottoming in mid-2022, the stock has formed a multi-year ascending channel with higher lows and higher highs, indicating bullish sentiment. It recently broke above key resistance around $570 per share, which had previously capped rallies in 2023 and 2024. The next psychological target is $600, with strong support seen at the $500 level. Momentum indicators, like the Relative Strength Index, suggest the stock is not yet overbought. And moving average crossovers, particularly the 200-day moving average rising above the 50-day, suggest a sustained upward trend. Volume has also increased during upward moves, which confirms institutional accumulation. Netflix's entry into advertising is a long-term catalyst. The global digital ad market is expected to exceed $1 trillion by the end of the decade, and Netflix's slice of this pie is still relatively small, but growing rapidly. The company has partnered with Microsoft for its ad tech backend and continues to build out its own targeting capabilities. By the end of 2025, it's estimated that 25% of new subscribers in mature markets will choose the ad-supported tier, which carries lower churn and similar or higher revenue per user. If advertising contributes even 10% of Netflix's total revenue by 2027, that could represent over $5 billion in incremental revenue at high incremental margins, given the fixed cost nature of ad infrastructure. Gaming is another frontier for Netflix, although it remains speculative. The company has begun rolling out mobile games tied to its IP and has even acquired several small gaming studios. While it is too early to quantify the financial impact, the strategic intent is clear: to increase engagement and build an ecosystem that extends beyond passive video viewing. If successful, this could improve lifetime value per user and reduce churn. Gaming could also introduce microtransaction and subscription-based monetization models that further diversify revenue. International expansion remains a powerful but underappreciated driver. Netflix's penetration in markets like India, Southeast Asia, and Latin America remains relatively low compared to North America and Europe. These markets offer younger populations, growing internet access, and rising disposable incomes. By tailoring pricing strategies and localizing content, Netflix could see outsized growth from these regions over the next 5 to 10 years. In fact, international net subscriber additions already outpace domestic additions, even as total ARPU is lower. As currency pressures stabilize and localization improves, the profitability of these regions is expected to increase. Investor sentiment has also shifted in favor of Netflix. After being punished in 2022 for subscriber stagnation, the company's narrative has shifted from growth at all costs to sustainable profitability. Analysts now value Netflix more like a media conglomerate than a hyper-growth tech stock, which reduces valuation volatility. That said, Netflix retains many tech-like qualities: network effects, global platform reach, strong unit economics that justify a growth premium over traditional peers like Paramount, Warner Brothers, or even Disney, which still relies heavily on legacy businesses. From a cash flow analysis standpoint, Netflix's conversion of net income to free cash flow has significantly improved. In 2022, the company generated under $2 billion in free cash flow despite reporting nearly $5 billion in net income, due to timing differences in content spending. But by 2024, free cash flow reached $5 billion and is expected to hit $6 billion in 2025. This implies a free cash flow yield of approximately 4% at current prices, which is strong for a company still growing and expanding globally. Operating leverage is kicking in as revenue grows faster than costs, particularly in marketing and tech development. In terms of risk factors, Netflix still faces strong competition from Amazon Prime Video, Disney+, Apple TV+, and newer entrants in emerging markets. Each of these competitors has unique advantages. Amazon bundles streaming with its retail business, Disney owns valuable franchises like Marvel and Star Wars, and Apple has enormous financial resources. However, none of them has yet demonstrated the ability to generate consistent streaming profits at the scale Netflix has achieved. Content quality and release cadence will remain critical, and missteps in programming could affect churn and engagement metrics. Another potential headwind is regulation. Governments across the EU, India, and other regions are scrutinizing global tech companies more closely. And Netflix may face content quotas, censorship challenges, or data localization requirements that raise costs or constrain growth. Tax treatment of international revenue and advertising practices could also change. These are manageable but must be monitored. Macroeconomic conditions could also impact Netflix's performance. In a high-interest rate environment, growth stocks typically face valuation compression, although Netflix's rising profitability and cash flows have helped it weather recent tightening cycles. Consumer spending trends matter too. If a global recession hits, consumers might cancel subscriptions, although streaming tends to be one of the more resilient forms of entertainment in downturns due to its relative affordability. Looking forward, Netflix appears well-positioned to continue growing earnings at a healthy pace while maintaining capital discipline. Analysts project earnings per share to grow at a compound annual rate of 12 to 15% over the next 5 years. Assuming no significant macro shocks and continued strength in ad-supported revenue and international expansion, Netflix could reach annual revenue of over $60 billion and free cash flow of over $10 billion by 2028. Applying a price-to-free cash flow multiple of 25 to that estimate would imply a market capitalization of $250 billion, which is still above today's levels but within reason given secular tailwinds. In conclusion, Netflix in 2025 represents a unique blend of maturity and innovation. It has transitioned from a growth story to a cash flow story without losing its edge in content, technology, and global strategy. The company's ability to unlock new monetization layers through advertising, gaming, and international localization provides multiple optionality paths for future upside. At the same time, strong cash flow, an improving balance sheet, and disciplined capital allocation create a compelling case for long-term investors seeking exposure to digital media with real profits and scale. As long as Netflix continues executing on its strategic pillars while maintaining content leadership, the investment thesis remains intact. If you found this analysis helpful, hit the like button, subscribe to the channel, and tap the notification bell so you don't miss our next deep dive. Let us know in the comments what stock you want us to break down next.